Now, for more on the oil industry and the energy sector as a whole, I'm joined live via Skype by Chiang. He's a Shale Research Analyst at Rystad Energy. Welcome to the show.
Thank you for having me.
So as we saw, a slew of oil companies releasing earnings there. Chevron, for example, taking an $8.3 billion loss in the second quarter, blaming the coronavirus for significantly reducing demand. Now, some analysts are using words like horrendous and brutal for the rest of the oil giants. What's your analysis of their performance?
Certainly what we saw with some of the quarter earnings coming in is, a lot of it was in line with expectations that, quarter two would really be the bottom, both in terms of, oil production as well as, the hits on earnings. Sort of looking at what they've done so far to kind of combat this is certainly focused on suspending, if not cutting, their dividend programs. Many of them have cut down on CapEx spending for the year dramatically. And, they continue to focus on, their more diverse portfolio, certainly with aspects outside of the upstream sector.
And as our reporter was saying, oil prices were already under pressure even before the pandemic. How much more complicated is the virus making pricing so far this year?
Yeah, that's a great question. So one of the complications we're looking at is the possibility of a second wave scenario. As you mentioned, we're already seeing, worsening cases in the U.S. and Latin America and other places. And so what we see is that if the second scenario does come into fruition, certainly in the September months, we're actually going to see 3 to 4 million barrels per day of global liquids demand come off the table, right? Additional volumes coming off. And certainly that's going to pose additional challenges to the recovery of oil prices.
So then as we look at some of those other factors that have been weighing on the industry most, how do you see that changing, if at all, post-pandemic?
Yeah, that's certainly interesting. What we've seen so far in looking at what super majors and other oil majors have done, certainly in the U.S., is one part focused on really consolidating their development positions. Specifically, the reason why, for example, the Permian continues to be a very active region compared to other oil basins is because it's really considered a very commercial position for many of these operators. So sort of looking ahead, operators will sort of focus on these high quality acreages to make sure they're able to salvage the best economics.
Now, I want to now turn to the global environmental backlash that we're seeing somewhat against the industry, and as well as the oil companies' reaction, especially in the US and EU.
Yeah. Certainly that has always been a very important topic, as we've seen with the issues such as environmental review of the Dakota Access Pipeline. What I will say is that in terms of flaring, as well as from an ESG perspective, certainly we have seen improvements both on the absolute volumes that are being reduced for flaring in areas like the Permian and the Bakken. But we're also seeing improvements in the flaring intensity, right? That's a portion of, percentage of gas being produced and how much of that is being flared. But the one caveat of that is, of course, if oil prices take a beating, that will limit the amount of spending that companies can make on improvements in reducing flaring.
Now, I do want to look at Chevron saying that it's buying Noble Energy in this $5 billion all-stock deal, the biggest U.S. oil and gas deal since the oil crash. What are your thoughts on that and what it might do for the industry? Yeah,
certainly that is a very encouraging sign for an industry that's perhaps slowly starting to stabilize after the volatility you saw in the first half. So our view is that, the deal for Chevron was a very smart move. Currently right now we're in a buyer's market where companies who are, relatively strong position in terms of the balance sheets are able to go find these bargain deals. In this specific case, Noble's stock valuation, their price had fell, almost half since the beginning of the year. And with that, they were able to actually be required by a fairly affordable price for Chevron. And with that in mind, we do see extremely good upsides for Chevron in synergies as they consolidate their Permian position with this deal closing.